Well, good morning, everyone. On behalf of Austar Ray White, it's a real privilege to welcome you to our webinar today. I see from some of the names and some of the faces there that some of you have been to previous webinars, so you know a little bit about what to expect. Today, we thought with this topic of tax changes happening and this changing environment that we're all working in or living in, it was important that we bring some clarity to the whole situation around tax. Hence, I've invited Mr. Nick Heijer to come along and participate in the webinar today. You know, as I know, we have some investors that are pretty experienced online today, but we've also got some people that are thinking of coming in as new investors into the marketplace. And so we wanted to try and tailor this that you all take something home today, something that you can use for your future decision making. So hopefully we achieve that. And we look forward to some of the feedback that we get afterwards, because we always survey after our webinars. We're always trying to do better and improve things. So hopefully we're achieving that as we go along. One thing I also need to tell you is that we've posted a phone number if you're in the chat box there. If you have any technical difficulties, phone that person, Amir, and ask him if he can help you through it. So hopefully there aren't any of those sort of questions or issues that you're facing today. Really, I think in today's terms, we have a situation where, as an investor, you kind of feel like the government policy is right against you at the moment. It's, you know, there's always been in New Zealand a real environment of health, a healthy environment, I should say, for investors to work and operate in. And I think some of these tax rules that have changed that we're going to talk about with Nick in a moment would indicate that there's a whole new policy. The thing that I have as a real estate industry professional in my mind is, how does this all play out? You know, how do we get to the end of this? And my issue is that if we don't encourage the private sector to invest in residential property, especially, but whether it's residential or commercial, it doesn't matter. If we don't invite the private sector to do that, what sort of issues is that going to bring along with it? Now, if we look at housing, and we all understand that the whole of New Zealand is in a position where there is a shortage of housing, so somebody's got to provide it. And if the private sector is incentivized not to participate, then the public sector has to do that. And I can't see how the government can actually afford it at the moment. So it brings a lot of questions and a lot of issues along with these changes. Now, it's probably time to actually properly introduce Nick Heijer to you. Nick's been a person I've known personally for 23 years now. And in that time, I've certainly gained a massive amount of respect for the man. And in his knowledge and the way he operates, he's very, very good in this arena, very, very much a specialist in this arena that we're going to be talking about today. But he's also very, very good around businesses and operating healthy businesses as well. So I'm suggesting and recommending to anyone that operates in that atmosphere or in that environment, you should be talking to Nick in the future. Nick is a partner in Bentleys. Now, Bentleys are a major firm throughout the world. So Nick will, I'm not sure if he's going to talk much about Bentleys. I think he's here to talk about what tax issues we're facing right now. So Nick, welcome along. And how do you see these new rules affecting investors in today's market?
Thanks, Len. Thanks for the introduction and the opportunity to talk about these latest tax changes. And it's great to be part of this this video series that you're putting on. Listening to Tony Alexander a couple of weeks ago, fantastic session. And I can only hope today lives up to that incredibly high standard you set last week. And yeah, it's going to be great to talk about some of the tax changes. It's probably a little bit of a dry issue, but I'm going to work really hard to make it as interesting and informative as possible. So maybe just to quickly answer your question, Len, it's probably worthwhile looking back at the history of some of the tax changes that we've had over the last 5 years. And we really saw a big change back in 2015 when the national government 2015, they introduced the test. It was for a 2-year period. And if you think back to that time, it was really heralded as something that would change the investment landscape for property in New Zealand. Now, we've gone back and we've had a look at what's happened since 2015 when they've made these tax changes. And the property market has continued to go from strength to strength. So what we've seen from the changes in 2015 and onwards, it's had very little impact on the property market. And I just want to point that out right from the beginning, because as we look at some of the recent changes, what we try and do is get a feel for what it's going to do to the market. What we can say from historical experience is that tax changes have had very little impact on the market. If we have a look at our cousins across the ditch, they've had things like capital gains tax and those types of things for a lot of years. And if we have a look at what that's done to the Sydney and the Melbourne markets in particular, it's had very little impact. So, I'd probably say as a starting point, Len, to the changes have had very little impact on the market, but we would recognise that the changes that we've had introduced most recently are probably the most significant tax changes that I've seen, certainly in my 30-year working career, and potentially they're bigger than anything we've seen at any point in the past.
Thanks, Nick. Look, I again, from my perspective, with this shortage of housing, it's certainly transpired into our property management business as well. We've got a significant portfolio of properties in our property management, and for the last 3 to 5 years, we've been working in an environment where we've had 1 to 2% vacancy factors, which I find incredible. So yes, the returns have always been very, very good as far as property management goes, or as far as investors owning rental properties. But I guess what's going to happen with these new tax rules, and you might want to elaborate on those rules, because as I said at the beginning, some of the people that we have here today have not had that experience before. Some of those rules will change the profitability of owning a rental property, if I could describe it like that. Do you want to go into a little bit of that detail for us, Nick?
Yeah, sure, Len. So I guess with these recent tax changes, what the government have attempted to do is to limit the gains to investors via 2 mechanisms. One is the bright line test, which we can really describe as a pseudo capital gains tax, and then the second very drastic measure that was announced on the 27th of March earlier this year was the removal of the interest deductibility on investment properties, which is really designed to penalise investors on a cash flow basis as on an annual type basis. So those are the 2 real changes. One is the extension of the bright line test to broaden the net of properties that are caught under a pseudo capital gains tax, and then the other is to actually make it less attractive from an income tax perspective on an annual basis by the removal of the interest deductibility. Now, when we look at the previous application, what's happened is that property investors have really held on to their properties for a longer period of time. So in order to avoid the tax payable under the bright line test, investors have said, I'm going to make sure that I get over that period of time. And if anything, what that's probably done is decrease the amount of properties on the market for sale because investors are hanging on to them for longer. In terms of the extension to the 10-year rule, that may start to get to the point where investors are saying, don't really want to be holding on to a property for that period of time. And if I do sell it before that 10-year period, I'm going to have to apply the bright line test and pay tax on the gain over that period of time. And so that may act as a barrier to more investors coming into the market. Against that, what we've seen when we look at the results of property prices since 2015, we look back at the numbers and we see that the median house price going back to 2015 in the Auckland market was a little over $600,000. It's now sitting at $1.2 million. So if you have a look at any investors that have held properties over that period of time, the capital gain that they've made has been way better that you can get in any other class of investment. So if you compare it to things like fixed interest in the bank or even many of the shares in the share market, property investors have had an exceptionally good return without having a lot of negative impact from the bright line test. Are the new rules likely to change that? It's really an unknown, but there's a very high possibility that these changes will have the same impact of previous tax changes, which have actually been very minor.
Nick, I should have said at the beginning, if anyone's got questions, please post them in the chat box at the bottom there of your screen. You can just type in your question, or we'll after you speak again, we might pause for a moment and see if anyone wants to turn the mic on and ask a question live as well. So we'll have both those opportunities. Nick, just getting back to that, what you were saying about the losing those deductions or the transitioning out of being able to claim those deductions on interest. Have you done an exercise, say for an average property, and say around $1 million, and someone's borrowing say $800,000 to buy an investment property? What sort of difference are the costs, say, over a 5-year period? Can you give us a bit of ballpark figure on that? I guess I know I'm putting you on the spot here, but maybe you've already thought about that for some of the clients that you work with.
Yeah, it's a tough question, Len, but we've done some scenario analysis based on what this would mean for individual investors, and some of the ones that we look at, to give you an example, we've looked at one with an average property purchase price of $1 million, which is probably around the Auckland market now. When we look at rental yields around 5% and interest rates of 4 or 5%, and then we take into that the capital growth that we've seen in properties over a period of time, and maybe moderate that on the expectation that property prices can't continue to increase at the level that they have, and then we look at that over, say, a 5 or a 10-year period, what we see is that there's a small increase in the cash flow costs associated with holding the property, but still very significant returns from the capital gains. So when we look at that scenario analysis, what we can see investors are going to consider moving forward, is it worth the opportunity cost of increased cash and tax flow, cash and tax costs from holding the property to generate the capital gain? And the answer that we're getting based on historical capital returns is that many investors will still look at residential property as a very attractive asset class. To give you some idea of cost, Len, on an $800,000 loan over a 5-year period, we're probably looking around an extra cost of about $50,000 over 5 years. which is an extra interest cost of about $10,000. But when you look at that in relation to the additional capital gain that it's generated, then for many investors, it could well be a very attractive scenario.
Yeah, well, it just pales into insignificance. So, and I'm saying that quite lightly, but $10,000 compared to some of the capital growth we've had over the last couple of years, you'd have to say, wow, is it a big issue? Is it something that should stop me going and investing in a residential property right now? And I guess only the people that are making that decision can judge that. But boy, sitting on the sidelines looking in, you'd have to say, oh, it's not a game stopper at all. When you listen to those sort of numbers, it's, yeah, definitely. We have got a question here. Someone's bought a second property on the 26th of March, 2021, which is a year's old. I think I see their building consent issued on August 2019 and CCA on the 15th of March 2020. Are the interest rates deductible or not? Do you want to answer?
Yeah, so that's so from what I heard on that, Len, the property was purchased prior to the 27th of March. Is that right? Yeah. So so just very quickly, as a bit of an overview on the interest deductibility rules. Basically, what's happened the 27th of March, then interest will no longer be allowable from the 1st of October, which was obviously last week. So if the property is purchased prior to the 27th of March, then interest is deductible, but on a phasing out basis. So and that phasing out period starts from the 1st of October. So from the 1st of October to the 31st of March, it's 75%. And then it's 75% up to the 31st of March 2022. And then after that, 2023, and then after that down to 50%, and then the following year down to 25%. So that by the year ended March 2026, there's no allowable for there's no ability to deduct interest.
Great, thanks, Nick. I guess we've got a situation now where some people might be considering moving into the commercial market. Do you want to outline the pros and cons of maybe considering that sort of option? Because as I understand it, the commercial market has been a little bit removed from all these changes. What's your feeling and what's your comment around that?
Yeah, it's very true, Len, that you know, these changes, these most recent tax changes introduced by the government are very much targeted at the residential real estate market. So you know, these changes make the residential market a lot more complex and complicated. And there has been thoughts that potentially it makes it a lot more attractive to go into that commercial property space. However, what we're finding from a lot of the clients that we talk to is that there's a lot more concentrated risk with commercial. It has a particular types of qualities that only fits certain types of tenants, that the risk profile on that is quite different to a residential property that's in very high demand and is very easy to tenant. So whilst the commercial landscape moving forward is a lot simpler and there's a lot less rules around deductibility and healthy home legislation and all of those other complicating factors, there's still a very large portion of our client base that know and trust and like that residential property space to invest in. And again, what we're waiting to see is what impact will these latest tax changes have on that focus. And early indications are that people still have a very they have a love affair with that residential space in the New Zealand market, and it's going to take a lot to convince them to move from that part of the market to the commercial space. And it was interesting listening to the comments from Tony Alexander last week. He seemed to echo those sorts of thoughts that, you know, that residential space, there's huge demand. There's an expectation that New Zealand's going to grow. The need for housing is going to be there for our foreseeable future, and people want to partake in that part of the market.
Okay. My next question, Nick, is, you know, I think, as I said earlier, we've got some very experienced investors participating today, but we've also got some very new or intending investors online today as well. Can you just explain how the bright line tax rate is worked out at point of sale? So say somebody was to sell it, say, under the 10 years and go, go forward with another purchase of some sort. How would that tax rate be worked out? Can you give us a bit of an indication on that?
Yeah. Okay. So the bright line test, in terms of what we put simply, what we're doing is we're calculating the profit that we've made in the time that we've had the property. So what we deduct from the sale price is obviously things like the purchase price, the cost of any capital improvement. So any work that's been done in the property over the time that we've held it, we can deduct that from the sales price. We can also deduct things such as real estate fees, which are, you know, for both the purchase and the sale, and we take those things off and we come up with what our profit is in the time that we've held it under the bright line test. Now, once we've got that, and as an individual, it will be at your typical marginal tax rate. So that's the process. What we find with this is that the key now, and this is something that people perhaps haven't been great at doing in the past, is keeping very good records around the work that we do on properties, and also keeping things like legal fees, real estate fees, those types of things, so that we're actually very clear about what the profit is from the sale of it.
Right. We've got a question there, Nick. Can property developers still claim interest on houses they develop for sale? How does that work?
Yeah, that's a really good question. So anybody that was entitled to a deduction under property development, they're still entitled to a deduction for that business activity. So if you're in the business of buying and selling properties, and that's part of your main business activity, yes, then you're definitely still entitled to that deduction for your interest costs. Right.
And one more that's just been posted, can repairs and maintenance expenditure be claimed against the capital gain?
They can be, but typically what's done there is those repairs and maintenance costs are offset against the revenue generated by the property in the period that the cost was incurred. So rather than saving up those repairs and maintenance and claiming it off the sale price at the end, you actually claim them during the year and offset it against the rental number. And it may be if you have significant repairs and year. So the best way to treat the repairs and maintenance is to claim those every year as you go through the process of filing your tax returns.
Okay, thanks, Nick. The process or the criteria around new builds, do you want to elaborate a little bit around that? Because that, to me, I can see what the government are trying to achieve with that. They're trying to encourage people to buy new homes and get that side of the real estate market growing quickly. But what I've seen from our side of things, investors that would have bought a residential property and just sat on it and rented it out are now looking at buying houses that are on developable land. And that side of the market has just gone crazy. And I think we touched on it with Tony Alexander a couple of weeks ago as well. You know, the amount of people that are really going hard to buy those sort of properties, I think, is filling the investor market even stronger, or making it even stronger than it has been. What's your comment around the new build situation?
Yeah, it's a fascinating area, Len, and this is where the big changes from the government have really come in. And I think for all investors, it's going to be very important to get a very clear understanding of the new build exemptions. And what I would encourage investors to do is to really think about the new build exemptions in two aspects. One, in relation to the bright line test, and then secondly, in relation to the interest deductibility rules. Now, if we look at the new build legislation that's being proposed around the bright line test, what the exemption is that rather than being subject to the 10-year rule, you're only going to be subject to the 5-year rule. So straight away, what that's saying is that potentially you can hold the property for a shorter period of time, sell it at a profit, and escape the obligation of paying tax under that bright line rule. So that's the first thing to be aware of from the bright line test. From the interest deductibility test, if you acquire a new build, then you can continue to claim interest on the property. So you can see that it will make quite a bit of difference to your tax return each year if you can claim interest on something that's considered a new build property. In terms of the announcement made by the government last week, the very encouraging thing for investors was their proposed definition around what a new build is. Now, generally a residential property will be considered to be a new build if it received a code of compliance on or after the 27th of March 2020. So that's an important date to be aware of. What it means is that there's already a class of properties out there that are considered new build properties. And as an investor, if you're buying one of those, you're subject to a shorter bright line test, 5 years instead of 10 years. And then secondly, you've got the ability to claim interest associated with the purchase of that property. Now, a couple of other really important things to note for investors, Len, just around these new build rules, is that the new build rule and definition is linked to the property. It's not linked to the purchaser or the investor. So that property could be sold a number of times, but it goes back to the date that the code of compliance was issued in that property. So for your investor portfolio, portfolio of clients, one of the things that they'll be very interested in now is when was the code of compliance issued on a property, and that will determine its interest deductibility rules and potentially bright line test rules.
Great, thank you. Got a couple of really good questions here. What about existing carried forward rental tax losses? How does that now play out?
Yeah, that's a very good question, Len. One of the changes that the government have made some time ago, and I think from memory it was about 2019. What they introduced was some legislation that basically we describe as ring fence rules. So in the year beginning 1 April 2019, the government have basically said that if you make losses from owning a rental property, you can only offset those losses against other rental profits. In the old days, we used to be able to offset those losses against other income, And if you were, say, a wage and salary earner as well as an investor in properties, you could offset your residential losses against your PAYE income and get a refund of those amounts. Unfortunately, that changed in April of 2019. But the good news is you can carry forward those losses and offset them against future rental income profits.
Great. Another question for you, Nick. Is there now a cap to the repairs and maintenance costs you can claim each year?
No, there's not a cap that I'm aware of, but there's a requirement to differentiate between repairs and maintenance and capital improvements. So typically the rule is that if you're repairing something back to its original condition, then that's regarded as repairs and maintenance, and you can deduct all of that against the income. If you're doing some work that's actually taking what you're doing and making it better than its original condition, then that's a capital amount that we may be able to depreciate, or if we can't depreciate it, then it's an improvement to the asset that we can claim if we have to go through the bright line test. So there's no limit. It's really a question of whether it's genuine repairs and maintenance or it's improvement of the property and it's a capital item.
Thank you for throwing some light on that. I've got one more question here, and if you're selling within the bright line test timeframe, like inside the 10 years, is the interest considered an expense along with purchase price, capital improvement, etc., or can you not use interest as an expense when selling too?
Good question. So the answer is that under the bright line test, you can't claim the interest deduction, and of course under the new rules, you can't claim it against the income as well. So that's the real negative of the proposed new legislation, that it's really just removing that ability for investors to get any benefit from the interest cost.
Okay. Another one, previously one would get a tax return on the loss. Are we still going to claim one as a loss?
Yes, so that really comes back to the point that we've just discussed around the ring fencing of residential losses. If we're making a loss, we get to carry forward that loss and we can certainly offset it against future incomes, but we can't offset it against other income. So the short answer is that we can carry it forward.
Right. Nick, this is my question now. For all current and new intending investors, what would you be advising them to do that they may not have done previously, going forward and making an investment in the residential market right now? Anything that stands out that they need to be really careful about? You may have even touched on a couple of those things a bit earlier, but I think it's important that you outline the pitfalls that can catch you at a later date.
Yeah, so the conversations we're having with clients at the moment, particularly as a result of the announcement last week, is just having real clarity around what these new rules mean from a cash flow perspective and from a potential future liability perspective. Now, what we'd say to the clients that we're talking to is that there's potentially a lot of unintended consequences that come about from having a bright line test extended up to 10 years. And to give some of your customers, Len, a bit of an understanding as to what some of those issues are, because 10 years is such a long period of time, quite often what will happen over that time is that people might restructure their affairs. As an example, they might like to move the property from their personal name into a family trust, or they might like to move it into one of the children's trust, all of those types of things. And when that happens now under a bright line test of 10 years, potentially those movements of properties are caught under the rules, and there could be a requirement or a triggering of the bright line test. So we need to be careful around those sorts of matters. What is under the proposed legislation is that there's a transition period. So for anybody that's looking to restructure their affairs and say move a property from a look-through company or from their personal name to a family trust, there will be an opportunity to do that over the next period. We'll get more information on that as these latest proposed changes go through Parliament. But when we're aware of those, it is important for investors to sit down and think about what these changes mean for their long-term planning. From a tax perspective, it's good to be aware of what it means from a cash flow perspective. The lack of deductibility around interest will certainly make it a little less attractive from a cash flow perspective. But as we said at the beginning, balancing that little less attractiveness of the interest deductibility against the capital gains that have been made in the past, that's something that all investors will need to sit down and have a good think about.
Right. Nick, I know most people that are online would have seen the fact that you've offered 5 lucky people a tax health check. We'll do a draw after we finish today and let everyone know who has won those tax health checks. For those who don't win it, what sort of things would you be offering in that tax health check? What would that be about? Because I guess some people, or most people, would have some sort of accounting advice in their life if they're investing in residential property. But what would you be offering as far as your health check?
Yeah, one of the key things that I'd recommend all listeners to focus on is maximizing interest deductibility. And one of the things that really bugs us when we get a new client and we do a review of their personal circumstances is situations where we see somebody's got some debt that's not deductible for tax purposes. And to give you a bit of an example, then what we see is people with a family home that they've got a mortgage on and a business that has very little debt in it. That, as an example, is a situation that's just not tax effective because we've got non-deductible interest on the family home that if it were sitting in the business, we'd be able to get a valid tax deduction for it. And with these new rules, that is going to be something very important for everybody to have a look at. And particularly when you have a look at the New Zealand economy and how important residential properties are in supporting small businesses. You know, it's very common for people to use their house as security to borrow money to put into a business. And what we really want to make sure under this new legislation is that people get a tax deduction where they're using equity in properties to use from a business perspective. And we know from a lot of files that we've looked at that part of things is not done efficiently, and it's costing people money every year by not maximizing the deductibility that they can get for interest. So that's certainly one of the top things we always look for, and we'd encourage everybody to raise it with their accountant at least on an annual basis, and just to confirm that we are getting that that efficiency in maximising deductibility of interest wherever possible.
Right, thank you. I think we've got one more last question that I'd like to put in front of you. If the client decides to develop the existing rental property into multiple brand new rental properties, is the building and development cost interest deductible?
That's a good question, and it really depends on what the intention is of the person doing the development. So if you're doing the development with the intention of resale at a profit, then you really are a developer, and because you're paying tax on all of your profits, then you're entitled to an interest deduction. If in the example that you just gave, Len, that somebody's doing a development with the intention of it being a long-term hold and they're never really intending on selling those properties, and they're going to rent them out and keep them as a long-term asset, then those are properties that would probably qualify as a new build and therefore have interest deductibility, but be subject to the bright line test and those types of things. So it really goes back to what the intention of the developer is at the time that they enter into the development exercise.
Okay. Well, Nick, I'm going to wind it up here, and I think you've made as you called it, a very dry subject, very, very interesting, mate. And look, if people haven't been able to take something away from this today, I'll be very, very surprised. Yeah, I think it's been incredibly informative. And look, I know you're very contactable and very easy to talk to. We'll make sure everyone's got your contact numbers as well. You might be getting a few other calls where people have just not had the opportunity to post those questions today, but really appreciate you giving up your time to be with us. And yeah, we'll look forward to maybe you coming back in a later time and maybe updating us on how things are working out. But for everyone else who's participated today, hey, thank you again for giving up your time and being with us. I'm really enjoying these webinars, and we're very, very much focused on making these happen every fortnight. So stay tuned for our next one. It's quite different, a more personable one we've got coming up, and we'll give you the heads up on that very soon. But again, thank you all, and we look forward to seeing you in a fortnight.
Thanks, Len. Thanks for the invite.